Okay, so we're going to go a little bit more in depth into the real estate market today because a lot of things have been happening, and so like I can say something, but I found that people do better if I can show it to you. So in summary, as I've mentioned before, rates right now, they're in the mid sixes. As of today, they're about 6.6%. And so what's happened is that's a lot of people got really good interest rates on their mortgages during the last couple of years. And so people who have owned their home for the last 4 or 5 years or longer, they refinanced their loan when the interest rate was down as low as the 3% range. And so now those people have this nice mortgage that makes it very challenging when they're going to sell, because then they need to buy a new house. And now as they're buying a new house, the interest rate is even higher, which means their mortgage payment is higher, and then they have all these challenges. So that makes things hard, because then now with that, not many people are putting their homes on the market right now. So now we have very little supply. Again, supply finally went up, but now is back to being low. So when you look at this graph, you can see that this is just showing over the last few years the inventory. And you can see back in 2017, 2018, it was relatively high. To note, this is for all of Southern California. When you get to 2020 and 2021, it got really, really low. And then interest rates went up, and you can see it peaked in August of 2022, where we were finally getting more inventory. So then we weren't having all this upward pressure on home values. They were starting to stabilize and even go down some, just because of the higher level of inventory and not enough demand to meet that inventory. But when you look at the end of that peak, you can see that it started going down again. So we're back to having an inventory problem. And what is resulting in us having these multiple offer situations right now, where homes are starting to sell above the asking price again. So we've been having this battle between low supply and difficult affordability, and it's like a tug of war. So right now, low supply is winning. Back towards the end of last year, affordability was winning, and so that's why home values were going down. Now that low supply is winning, home values are going up. So it's a constant push-pull back and forth of whether or not home values are going to be going up or down. Right now, for the foreseeable future, it's looking like they are going to be going up. Now that said, many economists have been wrong, but that's what they are generally saying right now. So then, since affordability is impacted largely by prices and interest rates, we know what's happening with prices. They're starting to go up again. In all of Southern California, they're collectively over this last year, they've gone down, but over this last month, they've gone up 2%. And in Orange County, they've gone up 3%. So then what about interest rates? Fannie Mae is projecting that this is what the interest rates are going to look like. Now, is this perfect? No, it's not. We're in Q2 right now, and we're at 6.5% roughly. So it already is off. It might be a little bit different than this. Clearly, it's just a projection. No one can predict the future, and I think we've seen this last few months that people are pretty bad at it when they try. But this is generally what they're expecting. The point being with this, that rates are generally expected to go down. And just to show you why interest rates are a problem, if you look at these different price points of 1.25, a million, and 750, at the different interest rates, you can see the difference in one's monthly payment. This is assuming that you're putting 20% down and person has perfect credit and all these different things. This isn't exact. Your number might be different. But as a general whole, this is about what they would look like at the different interest rates, which shows why the rise in interest rates makes such a big impact. Or for example, let's say you want to have a mortgage payment of $4,000 and no more. This is what a mortgage payment of $4,000 could get you at the different interest rates. So if it's at 3.5, you could get a 1.15 house. If it's at 7.5, you're looking at a $715,000 house. Right now we're around 6.5, so we're looking at just under $800,000 with a $4,000 monthly payment. So with that, you can see how the difference in interest rates impacts affordability so much, and why people aren't wanting to sell, because then they have to buy another home and then they have that higher interest rate. So we're gonna have this supply problem, this low supply problem, for likely a good while. And while we have that problem, we're gonna also have the problem with prices continuing to go up. Great for sellers, but if you're trying to buy, it makes it very challenging. Hope this helps, and if you have any questions, feel free to reach out and I'd love to hear from you.